Howdy there, folks. Welcome into the reaction channel. 2 for 1 here today. First video to react to. Jim Lebenthal says the market's move here is idiotic here recently, okay? Want to hear what he has to say. He believes, obviously, the market shouldn't be moving down, okay? Want to hear his perspective, and it's interesting because he's on with this gentleman from Short Hills Capital that is usually very negative and usually a bear on the market from what I've seen over time. So we'll hear if they kind of debate it out here and how ugly things might get, okay? Second video to react to here. Stocks will likely retreat to October lows due to weakening economy, says Joe Lefebvre. And we'll hear what his points are here, and maybe a little bullish and a little bearish action all in this video. I love to kind of hear different folks' perspectives on kind of what they're expecting here. Thank you, everybody that's subscribed to the channel. Thanks for being here. Nearly 24,000 Flip and Flapjack and subscribers strong now at this point in time. I appreciate y'all. Thanks for being here. Also, just so you know, everybody in the Patreon squad, I posted up the moves I just made in regards to Patreon portfolio. The stocks I bought in there, it was 3 different stocks this week. So if you want access to see the stocks I'm buying and selling now, check out the pinned comment down there. Also be the description area to join us in the Patreon. You get to support the channel. It's a no-brainer. It's like $2 or $2.50 a week to see all the moves I'm making and seeing exactly how I build out a portfolio step by step. So it's definitely very valuable to be part of that, and you'll definitely want to join us in there. Let's get into this.
Myself, Scott, but it's difficult. I think this move today is one of the most idiotic moves I've seen in the markets in quite a long time. Today's news is not news, okay? Last week you had the CPI and PPI for the month of January. They showed that inflation blipped up in January. PCE today for the month of January, which I will remind everybody was 24 days ago that it ended, is once again showing it hot. Okay, that tells us nothing about where we're going. Prior to that, you had 3 months in which inflation reports came in better than expected. So the question before us, Scott, before the Fed, before any investor, is which is the true story? Is January a blip, or is it a new trend? And if you look at commodity prices, if you look at goods prices, they are clearly showing that the trend to disinflation is intact. The question that hangs there, Scott, is what's going on with wages. I don't know the answer. Nobody knows the answer until we get next week's labor report. But to trade down today, whether you're an algo or a person, on yesterday's news, which is what today's PCE is idiotic.
Today's news, Weiss, Mester.
Okay, so basically he doesn't believe the market should be going down, okay? Let me push back against him for just a moment, okay? And kind of take a little bit of a more conservative bearish stance here, okay? We know the market's very driven on by what's going on in the short term, first off. But the second point is the most important point, okay? And that is, we have been slapped and slapped and slapped again by inflation. And we have seen it time and time again, especially throughout 2022, where it was expected inflation would come in better, it came in worse, and it came in worse, and it came in worse. And so naturally, when you see a very disappointing report like we just got here over this last few numbers here, people are going to automatically assume the worst in the market. And they're automatically going to be very quick to hit that sell button and be worried. And as we know, much of Wall Street is very concerned about short-term things, right? And where the market's going to move over the next week and over the next month. And so you see this sell-off. And although maybe, it doesn't make sense, we'll see what happens. It's just, I understand it from the perspective of, oh my gosh, inflation's coming in hotter than we expected, which means the Fed's going to raise rates more, which means they're going to keep rates higher for longer, and all those sorts of concerns. I'm very understanding of that. And we got to understand the market in short-term nature. It's what it does, okay? And at the end of the day, I think another important factor of this is we've been running very hot on the market. We're due for a pullback. And so the pullback we've seen over the past week and a half is very natural. It doesn't matter how bullish the market gets, you're going to have pullbacks. And so whether you're in the belief that we have started a new bull market over the past few months, or whether we're still in a bear market and maybe we just got a bear market rally, whatever your perspective is on that, like when the market's moving up, and especially if you even believe there's a new bull market that's formed over the past few months, you're going to have pullbacks in there. That's natural. We're due for that. We've been looking for a reason to pull back. And so when you get the hotter inflationary reports than expected, it's a perfect opportunity for folks to kind of position a little bit, cash up a little bit, and the market to take a breather, which is natural because the market doesn't go up in a straight line, just like it doesn't go down in a straight line.
Inflation's too high, do a little more to get price stability, bring interest rates above 5%, hold them there. How do you see it? I mean, Jim, he used the word idiotic on the sell-off.
If I were on the wrong side of the trade, I'd probably think it was idiotic also. But
ooh, that's straight shots. Oh, that's straight shots. Wow. Wow. Basically, he just called this man to his face, said you're on the wrong side of the trade, and so you're delusional, thinking this move is idiotic. No, to push back against this man right here, he capitulated recently. This man's been on the bearish side, and I think I reacted to that video actually on the reaction channel probably in the past week and a half, and he basically kind of capitulated. So I don't know about all that, okay, but that's just interesting.
I'm not. So I continue to be bearish. This fuels the bearish narrative. It fuels the narrative of being higher for longer with the Fed. The Fed is going to err on the side of doing too much. And I'll go back to what I said yesterday and all these times before. Both can focus on a single data point. They can explain away, say, this was expected. Are you guys idiots? What's new here? Which is essentially what we saw just now from my colleague here. But the reality is that it's directional. The economy directionally is slowing while the Fed is raising rates. So what's idiotic is to have multiple expansion in that environment. Multiple expansion's fine when you have trough earnings. We're nowhere near trough. So the market is way overvalued, will continue to decline as the economy worsens and inflation stays stubbornly high.
I feel really bad now. I feel really bad because now I realize.
Okay, wait, whoa, this is getting hot, okay? But I got to make a point on something he just said there that I think is very important, right? He says we're nowhere near trough earnings for companies. We don't know that, okay? Just factually, we don't know that. Maybe in his opinion, that's the situation. But it is very possible we could be in trough earnings for a lot of companies, right? If you listen to some of these conference calls, it sounds like a lot of these companies are going to have their net income, especially in terms of big companies, have their margins and net income, earnings per share, increase in 2023 versus 2022. Not all companies are going to fit into that category, but it's definitely possible for a lot of these big techs. They're going to have a more profitable 2023 than they did 2022. And you'll actually see nice growth for these companies as the quarters kind of tick on, and a stronger 2Q and 3Q and 4Q. And especially with the way a lot of these companies have cut expenses over this past quarter or so, where they've taken a lot of these one-time hits that have hurt their net income dramatically. Wait till they have to comp those numbers year over year. I mean, they're going to show likely very nice growth. So it's very possible net incomes increase, EPS increases for a lot of these companies. Like I said, not all of them. So unless the economy gets in such a bad place that it's just like devastation out there. But I think that's important that, it's something absolutely to factor in here. But man, this is a little juicy here. Holy smokers, this ain't no dang jokers.
Decline as the economy worsens and inflation stays stubbornly high.
I feel really bad now. I feel really bad because now I realize I just pulled a Weiss saying idiotic. You're right, Steve. I shouldn't use idiotic. Because that's your venue to say things.
It's fine to use you. About yourself, but
say
not
things
about
are
others.
Delusional, insane, stupid, stupidly insane, criminally insane. I mean, the number of adjectives that you've used when things are not going exactly your way to explain away data points is prolific.
But I mean, your case, let's be honest, okay? It's very easy to be negative. I totally get it, but your case is harder to make because a good economy, like you've been pointing out, only means more activity from the Fed, right? It means more demand that they need to crush. It means rates are likely to continue to move up or at least stay elevated. And that's a problem for stocks, isn't it? Regardless of how idiotic you think this move is, that is a problem. And that's what Michael Hartnett talks about today and why he says from the Bank of America Flow Show, S&P goes to 3,800 by March 8th. That's, a couple of weeks away. He essentially makes the case. Rates up, stocks down. Not that complicated. Yields are going to go north of 4%, and the S&P is going to go lower.
Give me good job bringing it down to taking the insults out. But I applaud you for that. Give me next week's labor report. Let's see how average hourly earnings are. I hate to wait 3 weeks for the CPI, PPI of February, but I'm telling you, this is one man's opinion, just one man's opinion. As far as what the Fed is going to do and the impact on the markets, you need to see February's inflation report to determine if January was an outlier or the start of a resurging inflation trend.
All right,
so that's a good point he just brings up there, right? You can't just jump to conclusions, because obviously inflation reports have been going our way for many, many months, and then you get this one bad report. We got to see if that's like a continuation, right? But once again, to push back on this point, people are going to always run to the worst case scenario when they've been slapped and slapped and slapped again, right? They're going to assume they're going to get slapped again. And so it's very natural that the market sees one bad report and thinks we're going to trend back up. I just think, I understand of that stance, and I think it's important that this gentleman understands as well, and all of us as market participants. When everything's it's no different when if everything's been going right, then you just keep assuming everything's going to go right, and then eventually that trend breaks and things start to go wrong, and you're like, what? And obviously 2022 was a perfect example of one of those years where just like it was thing after thing after thing. You had inflation coming in obviously extremely hot. Then you had this insane commodities bull cycle that we haven't seen in decades all of a sudden happen, right? Then simultaneously you had Russia-Ukraine happen, right? It was just thing after thing after thing after thing. The Fed had a raise way higher than expected. And it was just like, dude, like, can we get anything to work our way? And it just seemed like nothing, right?
Brenda Vingello, join the conversation. Weigh in on this little mini debate that we've had to start the show here on the desk.
Mini debate, sir. This is a fight. What are we talking about here?
Sure, thank you. So I think that it could be that January just ended up being overly hot. That's the time of year when everybody puts through a price increase. Usually salaries go up. We also had that significant increase in Social Security benefits that really probably boosted consumption during that time. But at the end of the day, I think if we look at data right now, you cannot deny that the consumer is still incredibly strong. They're not spending on...
True. First off, the company this lady works for, horrible name, Sandhill. I understand the other guy named Short Hills because it kind of fits together like short and stocks. But Sandhill, who wants to be on a sandhill, man? All I picture is you walking on this little sandhill and the sand's just like falling down. Like, that's just a horrible name for something stock market related. Come on, we got to come up with better names than this, folks.
All the things they spent on during the pandemic, but they're absolutely spending on all kinds of other things. Like travel, as we heard from Booking, things are really fantastic. They're spending on events and concerts. The consumer is still really strong. So I think even though that likely means the Fed is going to continue to raise interest rates here, I also think it might paint a little bit of a different picture in the shorter term for corporate earnings, because I think we had all been expecting that things would be really starting to slow down, that companies would no longer be able to pass along price and higher costs. And that dynamic might change a little bit, particularly for those companies in the services sector where we're still seeing demand be really strong. So I think it's not all potentially a negative here, but are we in for a choppy period? I think absolutely, until we can sift through all of this and really understand exactly what's happening. But in my mind, it's clear that the consumer is really strong, and that's such an incredibly strong part of our economy. That in my mind, that's a positive.
So she just hit the nail on the head with one specific thing she just said there. What she just basically talked about is a consumer spending on, like, let's call it stuff to do rather than things, okay? So meaning spending money on an event or going somewhere or doing something like that versus spending, spending more on services versus spending on goods, like buying a new TV or a new PlayStation or something like that, right? And so, and it brings me, I was actually watching a Weekend concert last night on HBO, right? And he says at one point, he sold out the SoFi 3 times. SoFi Stadium's like massive, right? And I know like when Bad Bunny came here to Vegas, he sold out the Raiders Stadium. I think it was twice, right? And I think he sold out the Cardinals Stadium, which fits like, 60,000 people in it 3 times, right? And so obviously, and those tickets are very, very expensive. It's like minimum, I think, $150 and like goes all the way up to, potentially thousands for what you're kind of looking for, right? And that just kind of shows you, like, people are doing stuff again, whether it's concerts, whether it's sporting events. And I think that was a reality that really hit in 2022. And, you had this kind of adjustment period. And e-commerce was extremely weak in 2022, like way weaker numbers than like anybody really anticipated, right? And Shopify was caught off guard by that. Amazon was caught off guard by that because all of a sudden a lot of people had these other opportunities to spend money. And so instead of spending an extra $400 on Amazon, people said, I want to go to this concert over here and spend $400 instead. Right? I want to go to the sporting event. I want to go on vacation. And so that hit all the e-commerce numbers, and I think it gave all the e-commerce companies unrealistically low growth rates. The Shopify's, the Amazons, I think all those companies are going to report much stronger growth rates in the future than they did this past year. But it gave an unrealistic reality behind that because the services economy really opened back up for real, when it hadn't really been like that, obviously, in 2020, especially in 2021 as well. Like a lot of people just didn't even consider going on that vacation or going to the spa and getting a massage or going to the concert or a sporting event and a lot of those different various activities, okay? So I just think that's a big factor that has to be remembered out there, and I appreciate that she hit that point in a pretty substantial way, okay? Next video up here Stocks likely to retreat to October lows. So obviously this is going to be a bearish video, and it's on the Fast Money Squad. And we know if you've seen Fast Money, the most of the guys on Fast Money, bearish, man. Bearish, always bearish. These guys always seem like, right? They have one or two females. I think one of her name's Courtney Garcia. And then there's the other lady, right? And those folks are usually typically, I can't think of her name off the top of my head right now, but those ladies are typically more of longs. They're thinking optimistically about the long term and whatnot. And the guys are always like freaking out over everything on the show, right? So we'll hear, but I would say more than likely they're all going to be on the bearish side.
Economic weakness could drive stocks back to the October lows. Joe Lavorgna, the former chief economist for the National Economic Council, he's now chief economist at SMBC Nikko Securities America, joins us. Joe, it's good to see you. You know, you've been in the camp. You've been expecting recession. The January data has shown anything but.
We had a GDP recession, or an inflationary recession early last year, and my guess is we'll see a more traditional recession, Sarah, this year based on the yield curve, the index of leading indicators.
So, and I want to hear what his points are. I'll actually back it up here. I just think this is important. I point this out. He was a former special assistant under President Trump. It is much more natural for you to think pessimistically if the opposite party than you really want is in office. Let's just put it that way. If Democrats are in office and you're a Republican, a lot of times you just think the country's doomed, right? And everything's doomed. They don't have any clue. If you're on the flip side of that and you are you're a Democrat and Republicans are in office, you think the country's going to hell and everything's ruined and we're all doomed as well, right? And so I just think you have to always take that for a grain of salt, and that's why I don't even get involved in the whole political realm. That's why I don't vote. That's why I don't do any of that, right? I'm like, let everybody else do that. Because once you start getting into your feelings, it's very hard to detach from that because people get so wrapped up into this. And so if the other party's in office, they think we're going to hell. It's all screwed, right? In reality, the stock market's done tremendously well under Republicans. It's done tremendously well under Democrats. It's done bad under Republicans. It's done bad under Democrats. You've seen it both ways over time, okay? And so I think that needs to be said and that needs to be factored in.
The senior loan officer survey and the fact the Fed has to get inflation back to 2%. And as you guys laid out quite nicely, the fact that it's not coming down as quickly as it's supposed to means that you'll have to have a recession to get that core rate lower, because you always get core rate lower when you have recessions. It doesn't happen on its own. So the January data look good. It does look like it's a weather effect. I'll give you a for instance. If you look at the production of natural gas and electric output, it fell 10% last month. That's the biggest drop with data going all the way back to 1939. So to me, this is a temporary reprieve on the data.
Yeah, a lot of people are saying January looks seasonal, but I don't know if the Fed is going to look at it that way, Joe. The Fed has to get ahead of inflation and has been leaning into the strong data.
The Fed, I loved Guy's comments that he's no fan of the Fed. The Fed waited way too long to raise interest rates, way too long. And then Jay Powell wants to be reappointed and he got his inflation fighting stripes. And now they've gone way too hard the other way. But as you know, Sarah, inflation is a lagging indicator. Monetary policy itself works with lags. They'll get ultimately what they want, which is lower inflation, but it's going to mean a recession, though.
Guy?
Yeah, Joe, what's their put? You know, we had a conversation with Richard Fisher. I think the put is in the form of the credit markets. I don't want to say seizing up, but sort of showing some signs, because it's clearly not the equity market anymore.
You know, the credit market for sure, because the credit market always causes systemic issues. And you're referring basically to the financial market breaking. My guess is it'll be something more banal. It'll be the labor market. The labor market shedding a couple 100,000 jobs a month for a few months in a row, with unemployment now quickly moving up into the mid to high fours. My guess is the Fed reaction function will change. Jay Powell will go from uber hawkish to being a dove very quickly. But of course, if the 100%. Credit markets break and there are systemic issues at the same time, that would only reinforce easing and the Fed pivot. By the way, I still believe in the Fed pivot, and I still expect the Fed to cut rates this year.
Wow.
Jeff?
That's a big statement. He expects the Fed to cut rates this year. Okay, let me share my perspective on that, okay? I would call it actually a 50-50 if they cut rates this year. I can definitely see a scenario where they cut rates, okay? The scenario would be unemployment starts to tick up. And it doesn't even have to do it in a major way. I mean, we're not even talking about like crazy amounts of jobs being lost, just jobs being lost and unemployment rates start to tick up. As soon as that happens, especially if it happens for 2 or 3 months straight, I can tell you the politicians in office, okay, Biden and the rest of them, and we already heard Elizabeth Warren come out this month about this, right? And basically say, the Fed, you're trying to ruin the economy, you're causing people to lose jobs. At this point in time, it's already clear the inflation numbers are coming where they're trending the way we are. Don't ruin the economy over this. And he'll start to face big-time political pressure, in my opinion. And that's when the Fed will start to consider about cutting rates at that point in time. And that could happen as early as this summer. Big if is if you saw unemployment tick up. If you don't see that, then even the politicians can't really come out and say anything. It doesn't hold any weight until you see unemployment start to tick up. Until that happens, it doesn't matter. You can say, oh, the Fed's going to do this, the Fed's trying to ruin this. It's not going to hold any weight. The only way it holds weight is when people lose jobs. And then you say, the Fed, look at you. You're causing people to lose jobs. You're causing minorities to lose jobs. You're causing elderly to lose jobs. You're causing, families to lose jobs, right? That's when all of a sudden everybody starts perking up their ears and they start blaming the Fed and the Fed's evil and this and that, right? And so that's the moment all of a sudden the Fed starts to freak out and then they end up having a pivot and next thing you know, they're cutting rates. But can happen until you start seeing unemployment start to tick up. And like I said, it doesn't have to be huge numbers. It could just be a little bit here, a little bit there. And that's enough ammo that they would start hammering the Fed.
You have something?
Hey, Joe, it's Jeff Mills. Just a quick question relative to interest rates. I know that your view later in the year is for the Fed to probably start cutting because of a recession. Can you just put that into perspective for people? I think we've all been so trained over the past 10 years to think of that first rate cut as being a good thing for the markets when historically maybe that's not the case.
That's right, Jeff. If you have a soft landing, if there have been 6 times where the Fed has cut and there's been a soft landing and the equity market's up massively in 3, 6, 9, 12-month periods by a lot, like 20, 25%. However, if the Fed's cutting and there's a recession, then those initial rate cuts are typically quite negative for equities. Historically, the timing from the last hike to the first ease is about 3 months. Over the last 5 cycles, it's elongated out to maybe like 11 or 12 months. But this Fed has been so aggressive, Jeff, and that yield curve I keep looking at every day, getting more and more inverted, and banks tightening standards. These are all classic cyclical signs that the Fed has overdone it. And yet, because of the point Sarah made in trying to get that inflation lower, the Fed's now stuck. They can't give you any nuance on the economy. They're going to get this economy lower, and that's going to be bad for equities. It's going to be bad for credit.
Really quickly, Joe, even the market has priced out the cutting notion.
Almost, Sarah, almost. They got one little cut in December.
You think there's going to be a cut because inflation comes down all the way to 2%?
No, I think
the economy is going to be hurting so badly?
The economy is going to be hurting so badly. For example, you could lose upwards of about 800,000 construction jobs, just construction alone, if you match what the labor market's showing on construction versus the inflation-adjusted construction data.
All right. Putting yourself out there, Joe. Thank you very much. Appreciate it.
Won't be the first time, Sarah.
No, we know.
No, that's a point, obviously, I've talked about several times on the channel, is if this housing market continues to weaken, then we'll hear what these other gentlemen's opinion is, which I'm pretty sure they're all going to be in agreement. And then also share my perspective on, what am I going to do if the market goes back down on those new lows, okay? But in terms of construction, okay, in terms of home building specifically, it's such a massive industry in the United States of America. I always call it the best thing that ever happens to the American economy is a new home being built. We know new home orders extremely weak, and we know they're likely going to stay extremely weak until mortgage rates shift, okay? And so the reason that's important is if we do not see mortgage rates come down anytime soon, likely home orders are going to continue to be dry, and the real estate industry is going to be in a bad place. The longer and longer time period the real estate industry is in a bad place and those home orders aren't coming in, the more and more likely you're going to see big job losses in that sector, right? Because there's not the new group of homes to build out there and all the other jobs that basically make money on that. And I've gone through this so many times on the channel over the past 6 to 9 months about how many jobs and how many companies make money off a home being built. It's ridiculous. Like, just walk around your house and you'll start to realize oh my gosh, there's so many different companies made money off this. So many different people added to building this. If you live in an apartment, even that, right? It doesn't matter, the countertops and the flooring and the carpet and, this and the appliances in it, right? And all the people that did the plumbing and then the guys that did the electrical on that. It's creates so many jobs. It's ridiculous. It's absolutely ridiculous. And you can't forget that. And so if you're talking about causing a huge pullback in that, obviously that's where you see major job losses. And that's something that would affect the economy very negatively into 2024 and potentially even into 2025, right? But it's so dependent upon mortgage rates. I can tell you, if mortgage rates tomorrow went back down to 3%, okay, on a 30-year, and you get, a 30-year 3%, and that was like the average out there again, like it was a year and a half ago, almost instantly, the housing market would be extremely strong. Homes would be selling again. People would be buying new homes. But, when you're 7%, it's a different scenario. People are scared to sign up for that. Or they're in a situation where they literally can't afford it, especially when housing's as expensive as it is right now, which we know housing prices are up there, very, very up there, like pretty much record highs, right?
California, let's trade this, Mike.
Yeah,
First to you.
I will say, look, one of the things I think that people really fail to grasp in a situation like this, if you look back historically at how much, say, S&P earnings can fall when things go the wrong way, we have rising capital costs. We had consecutive years right after December of 2007 where we had 16% year-on-year earnings declines for the entire S&P. And then again the following year. It was not until about 33 months after December of 2007 that we even got back to earnings where they previously had been. This is just not an environment that sets up very well.
Do keep in mind that was a great financial crisis, the worst economic situation we had since the Great Depression, okay? And so, could you see another scenario like that? It's a very low probability, right? Very, very low probability. It's a possibility, as all things in our market, but there's very low probability. And also the reason it's going to be very hard to get that is the Fed will do whatever the Fed has to do to prevent from that. And the government we're just in a different situation. Before the great financial crisis, for the government to step in the way they ended up having to step in later on down the road, right? It was seen as potentially socialist, right? Nowadays, people don't have that view. And I even talked to a lot of Republicans, and this was when obviously the shutdowns were happening and the government was giving all that money to businesses. And I have some very close, Republican friends, right, that are super into, obviously, Dems are the enemy and things like that, right? And so I was speaking to them about all the money government was giving to businesses and to people out there. And it was amazing. Those folks were actually for it. They were for it in that time. And I was just thought that was very telling that even some Republicans were okay with that. And so we're in a very different time period nowadays where if anything gets bad, people automatically are looking at the government hey, you guys going to do something? Throw some stimulus money out there, support businesses. Fed better get rates back down to zero. Support, do whatever it has to. So it makes it so hard to get another scenario like that where the markets go down 50+%. Like I said, as everything in the market's a possibility, it just makes it very, very difficult because nowadays states are ready to step in, the federal government's ready to step in, and the Fed's ready to step in and try to save the day as soon as you get any weakness. Like I just spoke about, if unemployment starts to tick up, even a 4%, which is still a super low number, I'm telling you, politicians are going to be all over the Fed, cut. You guys are ruining the economy, you're causing all these people to lose jobs, and what do you think the Fed's going to do? Regardless of if inflation at that time's at 4%, 3%, or 2%, they'd be like, okay, it's what's going to happen. Okay, it's the day and age we live in nowadays. It's a different market. It's a different philosophy around how we run money nowadays. It's much more MMT, as they say.
And, he was talking about construction jobs. We have 9 months supply now, I think, of new home inventory. These types of things are necessarily going to take time to percolate through, just like inflation has taken time to percolate through. And you end up in these kinds of waves, and I think that's what we're in. And I just don't think it's over yet.
Guy, I'm kind of bummed that Tim Seymour wasn't here because last time I was on the show, it was a month or two ago, he was giving me a lot of grief for saying, hey, the dollar could still rally this year. Everybody's on the one-way train, dollar weaker. Guess what? We're at a near 2-month high on the back of all this Fed hawkishness talk.
What have I told you for years, Sarah?
You told me to quit and go trade Forex. Yes.
No, I didn't trade you to tell you to quit. I said if you weren't an extraordinary journalist, you should be trading currencies at J. Aaron, and you would be great at that as well. And you're right. The dollar probably goes higher here. But if Joe Lefebvre is right and the Fed cuts in the back half of this year, I will tell you something. That won't be a very good environment because inflation's still going to be a problem. And you know what's going to work? gold's going to work. And I know you're going to be like, take your tinfoil hat off, guy, and I will later. But the gold market is poised here. Central banks have been buying it in record amounts. And if you catch a whiff that they're going to pivot, gold's going to go a lot higher.
All right. No tin hat. I think that's a,
I do
think
like
that's
that
a
Sarah
legit view.
Eisen. She is smart. But other than that, folks, as me, like, my hope is actually we do retest those lows. I don't think it's super probable, but I think it's a possibility if inflation continued to come in high, the Fed had to start, and everybody started running to the assumption that the Fed's going to start doing 50s again, right? Instead of 25s like everybody's thinking, right? Or maybe even they have to do 75s. If the market starts to run to that, then it's a possibility because everybody will be freaking out, panicking that you could get back down to those October lows roughly, right, on the market. And as a long, I can tell you, welcome it. Like, that would be a great buying opportunity. I would absolutely love that, okay? I'd absolutely love that. The thing we have as an issue this time is as stocks go lower, if we get it, stocks to go any lower, I can tell you a lot of the people that were very on the sideline last time are going to rush it because they missed a lot of stocks, right? They missed Meta under $100. They missed Tesla at under 120 and all the way down to 101, right? They missed, Shopify at 25. They missed Netflix at 160. They missed a lot of these opportunities. And they didn't realize how quickly a lot of those stocks could bottom and start coming back, right? And they went on to watch those stocks go up about 80%, 100%, some even more than 100%. They missed NVIDIA at 100, at $110, $120 it went down to. And so if we continue to go lower on this market, there's a lot of money that's going to be like, I'm not going to miss it this time. And so that puts almost a little bit of a floor underneath at least a portion of the market because they're desperate to add in. And I listen to a lot of these Wall Streeters talk on CNBC, right? A lot of them are talking about like, if this stock goes down to blah, blah, blah price, I'm going to be ready to buy, right? I was listening to one guy who's even talking about if Apple goes under 140, I'm ready to buy. At the same time, last year, a lot of people weren't even ready to buy Apple when it went to 125, right? And so it's just, there's definitely a much more desperate kind of like, I'm not going to miss it this time. If we go back down those lows, I won't miss it this time. And so that makes it hard to get back down those lows because you have a lot of people that are just ready to step in as you even start to approach that. So maybe you don't even get there. And I just think that's something I think a lot of folks got to take into account, right? But as a long-term investor, like I'm hopeful of that. I don't need my account to say this certain number next month or 3 months or 6 months. I don't need that to feed my ego. As somebody that's been doing this for 15 years, like it doesn't do anything for me. Okay. All I'm focused on is trying to get stocks at the best prices possible. And so if we can get the stocks lower, I'll gladly pick up those shares as a long-term optimist and believer in kind of what we have going on here, right? And what we've been doing for the last 200, 300 years, like I'm ready to take advantage of any deals and opportunities that are out there. So anyways, I appreciate every single person that subscribed to the channel. Nearly 24,000 subscribers now at this point in time. I appreciate y'all. Join me in the Patreon. It's a no-brainer. That will be in the description area. That'll be in the pinned comment. You get to see the stocks I'm buying and selling. You get to support the channel. And you get to see exactly how I'm building out that portfolio, the diversity of it. It's a pretty sick portfolio. So yeah, I appreciate you guys. Much love as always, and have a great day.